Welcome. Today we're diving into the world of consumer loans. Whether you're planning to buy a car, pay for college, or simply need some extra cash, understanding the different types of loans available can help you make smarter financial decisions. In this video, we'll break down the main categories of consumer loans, explain how they work, and highlight what you should consider before borrowing. Let's start by defining what a loan actually is and why people use them in everyday life. Loan is essentially money that you borrow from a lender, such as a bank or credit union, with the agreement to pay it back over time, usually with interest. Loans can help you achieve big goals or cover unexpected expenses, but it's important to remember that loans are a financial responsibility. The terms, interest rates, and repayment schedules can vary widely, so understanding these basics is the first step to borrowing wisely. Consumer loans generally fall into two main categories: secured and unsecured loans. Secured loans require you to put up something valuable like a car or house as collateral. If you can't repay, the lender can take that asset. Unsecured loans, on the other hand, don't require collateral, but they often come with higher interest rates because they're riskier for the lender. Understanding this distinction is key when choosing the right loan for your needs. Personal loans are one of the most flexible types of consumer loans. You can use them for almost anything, from consolidating debt to funding a wedding. These loans are usually unsecured, meaning you don't need to offer collateral. The lender will look at your credit score, income, and debt-income ratio to decide if you qualify and what interest rate you'll get. Personal loans typically have fixed monthly payments and set repayment terms. Auto loans are specifically designed to help you buy a car. These are typically secured loans with the vehicle itself acting as collateral. If you fail to make payments, the lender can repossess the car. Auto loans usually have fixed interest rates and repayment periods, often ranging from 3 to 7 years. Your credit score, down payment, and the car's value all play a role in determining your loan terms. Home loans or mortgages are used to buy real estate. These are some of the largest loans most people ever take. Mortgages are secured by the property itself, meaning the lender can foreclose if you don't pay. Mortgage terms can be long, often 15, 20, or 30 years. Interest rates can be fixed or adjustable, and your credit history, income, and down payment size all affect your eligibility and rates. Student loans are designed to help pay for education expenses like tuition, books, and living costs. There are federal and private student loans, each with different terms and benefits. Federal loans often have lower interest rates and more flexible repayment options. Private loans are offered by banks and may require a cosigner. Repayment usually starts after graduation, but interest can accrue while you're still in school. Credit cards are a form of revolving credit, which means you can borrow up to a certain limit and pay it back over time. If you don't pay the full balance each month, you'll be charged interest on the remaining amount. Credit cards are unsecured, so no collateral is needed, but interest rates can be quite high. Responsible use can help build your credit score, while missed payments can hurt it. Payday loans are short-term, high-interest loans meant to cover expenses until your next paycheck. They're easy to get, often requiring only proof of income and a bank account. However, payday loans come with extremely high fees and interest rates, making them a risky option. If not repaid quickly, the debt can spiral out of control. It's important to consider alternatives before choosing a payday loan. Installment loans are loans you repay in regular, fixed payments over a set period. Most personal, auto, and home loans are installment loans. The predictability of fixed payments makes budgeting easier. Interest rates and terms depend on your creditworthiness and the type of loan. Missing payments can hurt your credit score and may lead to additional fees or penalties. Revolving credit allows you to borrow, repay, and borrow again up to a set limit. Credit cards and lines of credit are common examples. Unlike installment loans, there's no fixed repayment schedule, but you must make minimum payments each month. Interest is charged on any balance you carry. Revolving credit offers flexibility, but it can also lead to overspending if not managed carefully. Loans can have either fixed or variable interest rates. Fixed rates stay the same throughout the loan term, making your payments predictable. Variable rates can change over time, often tied to market interest rates. While variable rates may start lower, they can increase, raising your monthly payments. Understanding the difference helps you choose the best loan for your financial situation. Interest is the cost of borrowing money expressed as a percentage of the loan amount. The rate you get depends on your credit score, income, loan type, and market conditions. Lower interest rates mean you'll pay less over the life of the loan. Always compare rates from different lenders before making a decision, as even a small difference can save you a lot of money. Loan term is the length of time you have to repay the loan. Shorter terms usually mean higher monthly payments but less interest paid overall. Longer terms lower your monthly payment but increase the total interest cost. It's important to choose a term that fits your budget and financial goals. Always read the loan agreement carefully to understand your repayment obligations. Your credit score plays a major role in loan approval and the interest rate you receive. Higher scores show lenders you're a responsible borrower, which can help you qualify for better terms. Late payments, high debt, or too many loan applications can lower your score. Before applying for a loan, check your credit report and take steps to improve your score if needed. Lenders often look at your debt-to-income (DTI) ratio to assess your ability to repay a loan. This ratio compares your monthly debt payments to your monthly income. A lower DTI means you have more income available to handle new debt, making you a more attractive borrower. Keeping your DTI low can improve your chances of loan approval and better terms. Sometimes, lenders require a cosigner or guarantor for a loan, especially if your credit is limited or poor. A cosigner agrees to repay the loan if you can't, which reduces the lender's risk. Having a cosigner with good credit can help you qualify for a loan or get better terms. However, both parties are legally responsible for the debt, so it's a serious commitment. In addition to interest, loans may come with fees such as origination fees, late payment fees, or prepayment penalties. These extra costs can add up, so it's important to read the fine print before signing any loan agreement. Ask your lender to explain all fees and factor them into your decision. Comparing total loan costs, not just interest rates, helps you find the best deal. Getting pre-approved for a loan means a lender has reviewed your financial information and is willing to lend you a certain amount, subject to final approval. Pre-approval can give you a better idea of your budget and make you a more attractive buyer, especially for auto or home loans. It's not a guarantee, but it's a helpful step in the borrowing process. Applying for a loan typically involves submitting personal and financial information, such as your income, employment, and credit history. The lender will review your application, check your credit, and may ask for additional documents. Once approved, you'll receive the loan terms and can decide whether to accept. Be prepared to answer questions and provide proof of your financial situation. Once your loan is approved and you accept the terms, the lender will disperse the funds. For personal loans, the money is usually deposited directly into your bank account. For auto or home loans, the funds may go directly to the seller. Make sure you understand when and how you'll receive the money, as well as your first payment due date. Repaying your loan on time is crucial for maintaining good credit and avoiding extra fees. Setting up automatic payments, budgeting for monthly installments, and paying more than the minimum can help you pay off your loan faster and save on interest. If you're struggling, contact your lender early to discuss options before missing a payment. Refinancing means replacing your existing loan with a new one, usually to get a lower interest rate or better terms. This can help you save money or reduce your monthly payments. However, refinancing may come with fees and could extend your repayment period. Always compare the total costs and benefits before deciding to refinance. Loan consolidation combines multiple debts into a single loan, often with a lower interest rate or more manageable payments. This is common for student loans and credit card debt. Consolidation can simplify your finances, but it's important to understand the new terms and avoid running up new debt while paying off the old. Faulting on a loan means failing to make payments as agreed. This can seriously damage your credit score and may result in collection actions, wage garnishment, or loss of collateral for secured loans. It's important to communicate with your lender if you're having trouble making payments. Many lenders offer hardship programs or alternative repayment plans. Borrowing responsibly means only taking out loans you can afford to repay. Before borrowing, assess your needs, budget, and ability to make payments. Avoid borrowing for unnecessary expenses or taking on more debt than you can handle. Responsible borrowing helps you build a positive credit history and avoid financial stress. Not all loans are created equal. It's important to shop around and compare offers from different lenders. Look at interest rates, fees, terms, and repayment options. Use online calculators to estimate your monthly payments and total loan cost. Taking the time to compare can help you find the best deal for your situation. Online lenders have become increasingly popular for personal and other consumer loans. They often offer quick applications, fast approvals, and competitive rates. However, it's important to research the lender's reputation and read reviews. Make sure the website is secure and that you understand all terms before applying online. Both credit unions and banks offer consumer loans, but there are some differences. Credit unions are member-owned and often provide lower rates and more personalized service. Banks may have more loan options and larger networks. It's worth checking both to see which offers the best terms for your needs. Peer-to-peer P2P lending platforms connect borrowers directly with individual investors. These loans are usually unsecured and can offer competitive rates. P2P lending can be a good option if you have trouble qualifying with traditional lenders. However, always review the platform's policies and fees before borrowing. Secured loans use an asset as collateral. Common examples include mortgages, auto loans, and secured personal loans. Because the lender has a claim on your asset, these loans often have lower interest rates. However, if you default, you risk losing your collateral. Always weigh the risks and benefits before choosing a secured loan. Unsecured loans don't require collateral. Examples include most personal loans, credit cards, and student loans. Because there's no asset backing the loan, interest rates are usually higher. Approval depends more on your credit score and income. Unsecured loans are convenient but require responsible borrowing. A line of credit is a flexible loan that lets you borrow up to a set limit, repay, and borrow again as needed. It's similar to a credit card but can be secured or unsecured. Lines of credit are useful for ongoing expenses or emergencies. Interest is only charged on the amount you use, making it a flexible borrowing option. Home equity loans let you borrow against the value of your home. These are secured loans using your house as collateral. They can be a good option for large expenses like home renovations or debt consolidation. However, if you can't repay, you risk foreclosure. Always consider your ability to repay before using home equity. Title loans are short-term, high-interest loans where you use your car title as collateral. They're easy to get but very risky. If you can't repay, the lender can take your car. Title loans often come with high fees and short repayment periods, so they should be used only as a last resort. Pawnshop loans let you borrow money by leaving a valuable item like jewelry or electronics as collateral. If you repay the loan, you get your item back. If not, the pawnshop keeps it. These loans are quick but often come with high fees and short terms. They can be helpful in emergencies but are not a long-term solution. Sometimes, emergencies require quick access to cash. Personal loans, lines of credit, or even credit cards can help in these situations. However, always consider the interest rates and repayment terms before borrowing. Emergency loans should be used wisely to avoid long-term debt problems. Loans can help you afford major purchases like cars, homes, or appliances. It's important to plan ahead, compare loan options, and make sure the monthly payments fit your budget. Borrowing for big purchases can be smart if you manage the debt responsibly and avoid overextending yourself. Student loans make higher education possible for many people. Before borrowing, explore scholarships, grants, and work-study options. If you need a loan, understand the terms, interest rates, and repayment options. Borrow only what you need and have a plan for repayment after graduation. Using a loan to consolidate debt can simplify your finances and potentially lower your interest rate. This works best if you stop using old credit lines and focus on paying off the new loan. Make sure the new loan saves you money and fits your budget before consolidating. Unfortunately, loan scams are common. Watch out for lenders who guarantee approval, ask for upfront fees, or pressure you to act quickly. Always verify the lender's credentials and read reviews. If something feels off, trust your instincts and look for another option. To improve your chances of getting approved for a loan, pay down existing debt, check your credit report for errors, and avoid applying for multiple loans at once. Having stable income and a good credit history also helps. Preparing in advance can make the process smoother and help you qualify for better terms. Before taking out a loan, consider alternatives like saving up, borrowing from family, or negotiating payment plans with service providers. Sometimes, delaying a purchase or finding extra income can help you avoid debt altogether. Weigh all your options before committing to a loan. We've covered a wide range of consumer loans, from personal and auto loans to mortgages, student loans, and more. Each type has its own features, benefits, and risks. Understanding these differences can help you choose the right loan for your needs and avoid costly mistakes. Remember, borrowing is a tool. Use it wisely. Thanks for joining us on this journey through the world of consumer loans. By understanding the different types of loans, how they work, and what to watch out for, you can make informed decisions that support your financial well-being. Always read the fine print, compare options, and borrow responsibly. Wishing you success on your financial journey.